Hi, everyone, and welcome to this week's Feliciano Live. We're here with Dr. Edmond Berisha. He is an assistant professor in the Department of Economics here at the Feliciano School of Business. We're talking about the topic of is a recession coming? As we progress through these questions, if you have any live questions, feel free to ask them, and Dr. Berisha will get to as many as we can. So welcome, Dr. Berisha. First question is, what is a recession?
Hey, thank you so much, Phil, for the opportunity, and more than happy to do this. So before I explain what recession is, I'm just gonna briefly go through what we use to capture in recession. So we have a gross domestic product, a measure that we use to capture what goes on in the economy, and what the measure does is captures the total new output that we produced, and the highest frequency we have is quarterly. So what is the total new output we produce every quarter? And that GDP tells us what the economy has been doing. As GDP goes up, we say that, oh, we are producing more and more output every quarter or every year. And the opposite, if it goes down, we say that the GDP has been decreasing and we are producing less. So the formal definition of the recession is, if I see GDP in 2 consecutive quarters have been decreasing, so we have negative growth, then we formally say we are in a recession. And that's kind of the official definition of the recession that the National Bureau of Economic Research uses to define whether the U.S. economy is in a recession or not. But the bad thing about this one is that to see whether we are in a recession or not, we have to wait for the data. So it's an ex-post event. So for the U.S. economy, it'd be very costly kind of to wait, oh, let's see within 6 months are we in a recession or not. So probably we need to have a better access to kind of indicators whether the country is in a recession or not. So.
For those who just joined us, we're here with Dr. Berisha. We're talking about, is a recession coming? Our next question is, can we predict the recession?
So it's very hard, because if I can predict recession for sure, then I can take positions in the market and I can make a lot of money. So it's very hard to predict, but there are some indicators that researchers have documented to work as a predictor for research for the recession. And one of the good predictors that has been shown is the yield curve. So the yield curve is the difference between the long-term rates and the short-term rates. And for example, the difference between the 10-year government bond rate and a 3-month rate. And what the research have been shown that whenever this spread like converts, like it inverts. So whenever the spread becomes smaller, it's indicating that the economy is going to slow down. And I will explain the intuition in a little bit. And the opposite, whenever the spread increases, that's an indication that the economy is expected to grow. I mean, just reading the literature, I've seen that the spread does pretty good job in predicting the economy. But again, since 2008, a lot of things have happened with quantitative easing that the Fed have been initiated, and now it's becoming very hard to read what is the yield spread telling us anymore, because since 2008, we didn't let the market determine what's going to happen to the long-term rates. We had Federal Reserve stepping in and buying the long-term bonds, so artificially sort of decreasing the rate. So that's why it's very hard now to read what is the yield spread telling us. And the other good indicator that at least I see in the U.S. is paying attention to the housing market. So one good indicator would be what's going on with the housing permits and what's going on with new construction in the housing market. So construction companies are going to be forward-looking. So no construction company will build new houses if they feel the demand is not going to be there. So if we see the number of new houses built is going down, that should indicate that the expectation is the economy is going to slow down. The opposite, if we see the number of new houses being built is going up, that's an indication that the economy is going to improve, because construction companies will build the new houses under the expectation they can sell those new houses in the future. So they can sell those if people are making more money, and if people make more money, that means the economy is expanding.
So what are the underlying causes of a recession?
Now, it's again, the mainstream depends in economics, but the mainstream economies, they quantify both demand shocks and the supply shocks as causes of a recession. Demand shock has to do with consumers, so how consumers behave, and supply shock has to do with producers. So from the consumer's point of view, if people feel uncertain about the future, they are going to spend less, and on aggregate, if everybody spends less, demand will go down, and that can put the country into recession. And supply shock, whatever the price of resources unexpectedly go up. Let's say we see a positive increase in oil prices. That is considered a supply shock. If that happens, the resource prices are becoming higher. They are becoming expensive. So that will cut into production. And whenever production decreases, businesses will employ less. And that can put the country into recession. So it can be within the country, demand and supply shocks happening, but also can be outside the country. A shock outside can harm our exports, and through our exports, also we can have a recession, which can be considered export or considered sort of a demand shock in this case.
So what could policymakers do to prevent a nearing recession?
At this point, I mean, we have fiscal policy, which is change in taxes or change in government spending, that it can be used, and they have been shown to be very effective in fighting recession. And what I'm trying to say here is whenever the country is in a recession or slowing down, we can use lower the taxes, encourage people to spend more money, businesses invest, and support economic growth. But we are right now in a situation where we already had a tax cut, and if for whatever reason, if U.S. economy enter recession, I don't think we have, at the moment, a lot of room for lowering taxes because we already did. And another option is monetary policy, lower the interest rates. And through lower rates, you can help the economy recover because lower rates will make borrowing money cheaper. People will borrow more, and they will start spending, investing, and that can help the economy recover. But again, even for the monetary policy, we do not have a lot of room because the rates, yes, have been going up, but just a little bit, and there's not a lot of room to go down to zero. So there's just a little bit of room to decreasing rates, at least for the U.S. economy. So hopefully we don't see a recession anytime soon because in terms of fiscal and monetary policy, personally, I don't believe we have a lot of room to fighting a recession at this moment.
How will the recession affect the job market, both short and long term?
So, recessions, short-term, long-term are bad because short-term causes unemployment to go up and means people are getting unemployed. And in the long term, what happens is even right now, we see in the long-term recession discourages workers to look for a job. And it can harm knowledge too. So it can harm the human capital as well. If I'm unemployed for a long time, I will lose my knowledge, I will lose my human capital, and it will become even harder to find a job. So that's another bad side of the recession, which if my knowledge depreciates because of me being unemployed, then that can harm my productivity as well. And if you think on aggregate, the recession can harm a country's productivity, and this is what the research has shown. So that's why what we do, at least in US, we have learned a lesson from Great Depression. We try to be very proactive when it comes to economic slowdown, and we have a Federal Reserve that tries to be very responsive in making sure the country does not enter recession, because recession are literally economically very costly, but also from a social perspective, they are costly too, because it can create other social costs, like increase the number of divorces, suicide rates, other things too, which we need to take into account whenever the country enters the recession.
So what signs can we look for in the stock market to show a nearing recession?
It's very complicated, but the best answer I will have is, again, investors are forward-looking, so nobody will invest money if they believe the economy is entering recession. So if I see stock market dropping, that's an indicator that investors are feeling pessimistic about the future. So that can indicate, if I see drops in stock market happening, that's an indicator that the expectation is the economy is going to slow down. And the opposite, if I see the stock market is doing really good and people will invest under the assumption they will make money, so that's an indicator that investors are feeling optimistic about the future. So if I see a slowdown in the stock market, especially in the growth rates on indices, that should signal that investors are not feeling very comfortable about the future. They are feeling that the economy is slowing down, and that should indicate that the recession might come.
What effect will student loan debt have on the recession?
I mean, the effect of student loan, I don't think it's going to matter a lot, like going the student loan debt to the recession. I think where student loan matters a lot, because what I'm thinking on my mind right now is student loan over the overall debt, it does not play a big factor. We have to look at the overall debt, and research have shown that overall debt matters for the economic negative growth in the economy. So research have shown that higher debt harms the economy. But in regards to student loan debt itself, I don't think it will add into recession, but what worries me a lot is if the country enters recession, it's going to harm the most students with a lot of loans. Because if the country enters recession and a student has a high debt, that means the likelihood of finding a job is going to decrease. And if you have a lot of debt, it can harm you even long term. So I think that the effect would go, recession will harm more those that have higher debt because they will have less room for spending, because if you have a lot of debt, you have to worry about paying off the debt and not like invest, which can drag on into the economy and harm the recovery after recession.
Should the Federal Reserve continue to increase rates even if many predict a recession on the horizon?
I mean, Federal Reserve has very well-prepared economists, so, and to me, at least paying attention to what is going on recently, Federal Reserve has been trying to be ahead of the curve in regards to setting up the interest rates. And I think they learned the lesson from November and December. They are not going to increase the interest rates, and they made it very clearly, even this year, that they are going to be very careful in raising the rates, and they are not going to raise the rates for a while, at least for this year. This is my impression. And no, they are not rising, and it's bad for the economy right now to increase the interest rate, because we are not seeing a slowdown in U.S. The slowdown is also happening outside U.S., like in China and Europe. And Federal Reserve is becoming very careful in regards to how they also are communicating the policy rate path as well. And they made it very clear to the public that they are going to be very forward-looking in regards to how they are setting up rates. And Federal Reserve, what they also pay attention is to inflation expectation especially. And what we are seeing is the expected inflation is low, and Federal Reserve right now is also feeling much more secure in regards to not increasing the rates, because under the impression is if inflation does not pick up anytime soon, that's an indicator that we shouldn't worry about operating above the full capacity, because if inflation does not pick up, that's an indicator that we shouldn't raise rates and harm the economy.
So how can investors better prepare for an upcoming recession?
Now, it's this kind of depends how risk-averse an investor is. If you are highly risk-averse and you don't feel comfortable about uncertainty in regards to what if there is a 10% drop or 20% drop, then an investor should move more toward the riskless asset like government bonds or treasury bills, so hold more liquid assets and invest less in equities. But if you are, especially if you are young, and again, you're going to be here for a while, so you shouldn't worry too much about what's happening right now. Yes, we have seen, like last quarter, we have seen a drop down, but now we saw a pickup. So there is volatility in the market, but if you are young, my presumption is stay in equities. I mean, if we get a good deal with China, and we saw ECB even today, they increased money supply. So my assumption is the economy is going to keep improving and increasing. So my assumption is the equity is going to kind of revert and keep going up. So depending where you stay in regards to risk aversion and your age, sort of, if you are close to retirement, probably you want to move toward more risk-free asset. But if you are young, then probably stay more in equities and try to kind of gain from the returns on equities.
So in your opinion, is a recession coming?
My personal opinion is that at least for this year, we are not going to see a recession, because as I mentioned before, Federal Reserve is becoming very forward-looking and indicating that they are going to be very proactive in setting up the monetary policy and support the economy and grow. We also saw today, as I said, ECB becoming very proactive and helping the entire Eurozone and European Union to recover, sort of support boost the economic growth. So this year, no. Are we going to see economic slowdown? Probably, but it's not going to be like in a formal definition, a recession, but probably a slowdown is something we are going to see. But again, we should look at the data. We are literally operating, especially U.S. economy is operating at full capacity. Unemployment rate is 4%, which is below the natural rate of unemployment. Like there is not a lot of economic slack in U.S. economy. But what came to, like just looking at the data, what came to my attention is labor force participation. Still, labor force participation in U.S. today is lower than what it was in 2007, which means that we still have people out there who probably are going to encourage to join the labor force and help the economy recover, which to me is an indicator that we still have room to shrink the economic slack in the U.S. economy. And I don't think we will see, like to conclude this, I don't think we are going to see a recession at least anytime soon.
So we'd like to thank Dr. Berisha for his time, and as well as we'd like to thank, actually we have a live question. How does government spending have an impact on recession possibilities?
Again, now it depends on which country you are looking at, but if government spending gets under the control and government spending the money that government spends needs to come from somewhere. If government spending, if the money that government spends comes from debt, that can harm the economy, because if there is a lot of debt being accumulated due to higher government spending, then the debt will send uncertainty to investors, and that can increase the interest rates and harm the economy. But at least for the U.S. economy, a lot of economists are encouraging more government spending, especially on infrastructure, to renovate the infrastructure in U.S. And interest rates in U.S. are pretty low in comparison with the other countries. So the indicator is that investors are still trusting the U.S. government in regards to loaning money. So a lot of economists are suggesting that since the interest rates are low, this would be the right time to borrow money, invest in infrastructure, and help kind of even further boost the U.S. economy.
Great. So thank you, Dr. Berisha, and thank you all for joining us. We'll see you at our next Feliciano Live in a couple weeks. Thank you all.
Thank you so much.